The second statement that I have to create here is my statement of financial position, otherwise known as a balance sheet. This is a account that has to show how much the value or what's the value or worth of any company. It shows all the assets and all the liabilities. So first thing we start with again is the title. Title is the balance sheet as at, and it's as at, it's at a period of time. And again, the period of time we're given for is the 31st of May 2007. You can also call it a balance sheet for Colin Buckley as at 31st of May 2007. Again, dollars in thousands. Okay, very first thing you have to remember for a balance sheet is you start with long-term assets, which are fixed assets, sometimes called non-current assets. So my fixed assets here are 1250. So this is the same information as the last question. Let's see here. So this is it there. 1250 is going to be my fixed assets. I put that in there. These are things like machinery, vans, things like that. Sometimes you have depreciation, where you have to take a certain percent of those assets and reduce it, because obviously things like cars generally their value drops as they've been used, wear or tear, things like that. This case there's no depreciation. Fixed assets, that's the first thing. After that, current assets, so long-term assets, short-term assets. These are things that I own within 1 year. So I own these, and within 1 year the value of it will probably change. Debtors, I own that. It's money that's owed to me. So it's money that I'm to be owned by that I will own, that will be sent to me by my customers who haven't paid me yet. I also have cash, which obviously I own, and the stock, which is my inventory that I currently own, not to be confused with shares for different companies. This is like inventory. This is inventory. So it's not like actual stocks and shares. It's stock as in Carrefour, all of the things that are in the aisles. Okay, those three figures are 50, 350, 550. I put the three of those figures in and I add them up. They're my current assets. That's my total current assets. After that, long-term assets, short-term assets, short-term liabilities. That's the next thing we deal with. Money that I owe within 1 year. And we have creditors, which is money that I owe to my suppliers. And we also have borrowing, but we're told it's short-term. So this short-term borrowing will be treated as current because it's within 1 year. We're told it's short-term. There's two things, creditor, short-term borrowings. The figures are given. I put them in. I add them up. It's 585. 585,000 is what I owe in the short term. 905 is what I own in the short term. And so the difference between those we call our working capital, sometimes called just put that in here as well. Sometimes called net current assets. So my net current assets or working capital is the difference between the two short terms. Obviously, assets are positive, things you own, so you just take away the things you owe. 320 is what I'm left with. That's the amount that I own in the long term, the amount that I own in the short term, the amount that I owe in the short term. There are the three headings we've dealt with so far. All we do is we get a subtotal just for the current assets and current liabilities, and we have that there. Now this figure's in the second column because it's important for calculating. The very last thing, long-term assets, short-term assets. Short-term liabilities, long-term liabilities. This is money that I owe to my I suppose to banks, whether it's a mortgage or a loan or a debenture or anything like that, to be owed another company. It's long-term borrowings, and we can see here it is loan capital of 550. It's money that you owe. So there's loan capital of 550. I can put straight in here. It's the only long-term borrowing. Long-term assets, short-term liabilities, long-term liabilities. I've dealt with the two short terms. I've got a subtotal, and now I just have to simply work out the rest. This is money that I own in the long term. It's positive. The assets were greater than the liabilities, so therefore this is also positive. I'll add that. I'm going to take away the liabilities because I obviously owe those. And so I'm left with 1,020 as my net assets. My net assets are 1,020. Okay, so we've dealt with that. That's my net assets. After that, the final part, the last third of a balance sheet, is financed by. This is how the company was financed, whether it's a profit they've retained through previous years, or also, just simply the money that's been invested by shareholders or by me, the owner, or anything else. In this case, there's always generally two. Sometimes you have drawings as well. It's if the owners take money back from the business, which is the opposite of capital. The first thing we see here is share capital. We're given it's 350. So you just put that figure in. You're not actually given anything else to put in here. Again, just like we had seen here for this top section, sometimes they didn't give us figures and they just gave us the bottom figure and we have to work out the difference. They're just asking, making sure that you have full understanding of the question. The figure that we're missing is the retained profit over the years, not the retained profit from just this year, but the retained profit from all of the previous years, retained earnings from all of the previous years. And so I have my share capital, but I don't know this figure. My retained profit is not given. But this is the balance sheet, and we know that this bottom figure down here and this figure from net assets, they have to be the same. My capital employed has to be the same as the net assets. So just for this question, you will simply have to calculate the difference between the total capital employed and the share capital, and that is your retained profit. So in this question, this one here was the, just darken this one here, this is the missing figure, the 670. It's profit that you've retained through previous years. Usually it would be given to you as with the share capital and you have to work out this bottom figure. But obviously they're just a different way of testing you. They're making sure that you understand that this is the balance sheet so that you actually know this figure down here and that this is the figure that you need to calculate. That is the balance sheet. It tells us that the company has a worth of 1,020 once they've paid off their short and long-term liabilities, and that's how much money has been put in by equity or retained profit that has financed the business as well. That is the trading profit and loss and balance sheet for Colin Buckley.